Hi, my name is Jonas Thulin. I'm head of asset management here at Erik Penser Bank, and I will try to briefly explain and derive our house view. First of all, the methodology is the same. We are a pure quant house, pure econometric house, and we run all our views on data. Now, the first point of view that I think is quite important to bring with us going into this week and next week, etc., is which paradigm is running the equity market. And we know that we had a huge run in political risk. This is actually a statistical explanatory power between US political risk and the equity market, being almost 0.6 in January. That quickly faded away as we were entering into a geopolitical risk, i.e. the war. That quickly faded away as we ran into an inflation trade, and then we ran into a financial conditions trade. And now we're running into a US macro trade. And I think that's quite important because obviously that with the pivot that we already have had, sets up the stage for Q4, which sort of works for us quite well because this has been our house view. Now, in terms of the date of the week, remember the US is still in a positive territory in terms of how data beats the consensus. We believe that orders will come in a bit lower in the US, but that is already the consensus view. This shouldn't budge the market. If anything, probably yields lower, equities up, etc., etc. So no big risk reward here because we're already heavily front loaded in equities, and also we're long US treasuries. So if this model is right and the consensus is right, perfect. That's great news for us. PMIs, we tend not to put too much weight on PMIs. I know there are a lot of people are doing this. The reason why we do not do that is because equity markets are leading PMIs and especially leading ISM, hence a bit useless to form opinions on. We think it's a bit interesting. I mean, we have this soft landing in the US. Obviously, we have, as we've been claiming, recessions in Europe and elsewhere. But that said, we still believe that this was the time to buy European equities because this, as we showed last week, this slowdown has already been priced and we actually start to see rebounds. PMIs probably won't rebound for a while yet, but that said, remember, PMIs and ISM, always when things turn around or peak, have a tendency to lag. In terms of US PMI, we're not even convinced we're going to see a sub 50 reading this month. We actually might see an acceleration. Now, this model is a bit, I shouldn't say, you can see by yourself, the discrepancies are quite big sometimes. It's just built on earlier released survey data, which I think is quite interesting to follow anyways. So it's, that's the situation on PMI. Now, why aren't we more concerned? Well, we believe that ISM and PMIs are actually, we're going to see the trough and it's going to start to rebound. And this is actually, this green line, which we forecast the ISM with, is actually more correlated to the equity market, if anything. So how is this environment at all created? The reason is this right-hand graph, is the fact that we have a strong sales and trade in the US, for example. Now remember, in Sweden we were already in a recession in terms of the consumer demand before we started hiking rates, i.e. this is a quite unique situation the US is in, i.e. they can hike rates, they can afford it, they can also manage a soft landing, and not so much in Europe. All that said, that's already been priced, so this is a bit of yesterday's news, so we start to chase the other way around instead. We have Riksbank, they're meeting on Thursday. We actually see a 50 basis points hike. They're probably going to hike by 75 basis points because they are who they are, but they should, I think, only hike by 50 basis points. And the reason for that is they have been appallingly bad in terms of forecasting their own rate, in forecasting unemployment, and forecasting the kicks. So I think they should probably slow down in line with the language from ECB and Fed rather than going full-hearted. Because remember, we're already in a recession in terms of Swedish consumers. And we were before they even start hiking rates. So this is really the homework hopefully they've done. The market is a bit more hawkish than they are, i.e. there's still room for Swedish krona to be disappointed, which is our position still. In terms of house views, nothing has changed really from last week. Yes, we still see Fed peak hawkishness. We think that's over and done with, the pivot done in October. We can close the history books on that. Peak yields, hopefully we can close the history books on that one as well. That's our position. Peak inflation, we can definitely close the history books on that one as well. So all that is sort of old stories for us. Our view on Q4 has been that we should see this rising equity market we're getting good traction on that. So it's a little bit like we can lean back and we can start to change allocations because they're not giving us enough positive returns or positive momentum, which is a bit different from previous in the year where we tried to limit the damage in the portfolios. So that's what I usually call luxury asset management, is that we can start to pick relative winners rather than avoid relative losers. It's a completely different ball game. Our house view is, as you can imagine, unchanged. Now the strategies are still the same. We've added Eurozone equities. We're probably going to add some more because we know there's an upcoming recession. But as you all know, that this is the equity market's job to forecast this and be ahead of the game. We think the equity market's done a good work on this one as well. We have a larger than usual allocation to Nordics, Swedish equity markets, for example. The reason for the strong support on equity markets is still the same. Now, the tactical asset allocation is hugely important, has been throughout the year. That's because both rates and equities have fallen in value, so you have to choose where you can be tactically active. And by working with this, we are managing to beat our benchmark in 80% of our portfolios. Now, this is including the entire portfolio. I mean, both the SSA and TAA, obviously, and I mean, the benchmark is what it is, and our performance is what it is. We're only looking at mandates or portfolios with over $50 million in gross of fees, but the underlying costs are included. And more information on this is in our master presentation. Give me a call or a note, and I'll send that over. There you have all the benchmarks and how everything's calculated, etc., etc. But obviously, it's good fun for us to still be in the green light. Obviously, on a relative basis. But please also note that a few of our products are measured on a 5-year rolling performance scheme, and they're also green. So despite the massive sell-off this year, we are maintaining our medium-term performance. Now, obviously a bit helped by that we've been fairly positive in terms of damage control on equities. Now you could start to think, well, we put down the dollar weight, but the dollar weight's actually moving up, and that's because the dollar positions that we still have are doing a tremendously positive work. So they are just increasing the piece of the pie. From a currency risk exposure, that means that we're probably going to have to take off even more dollars because the underlying equity strategy is so strong. So this is the puzzle that we always have to work with in terms of the FX and the underlying measurements. But it's also quite interesting to see that the strategies that we are maintaining in dollars are doing extraordinarily well, which sort of gives us the affordability to have this work in terms of FX as well. But the strategy is quite clear that we still sort of sapping away from dollar exposure, and the better they are performing, the better take profits we're going to have. The strategies are still the same. It's good fun to see this inverted. US political risk is inverted. In terms of CPI, I will actually not go through. These are the graphs that I usually talk about, but we think that the CPI, the peak and rollover and everything, that is a done deal. We don't have to go through this anymore. We update it every single day. Unless something extraordinary happens on the upside, CPI breaks the trend and starts to trend upwards, we probably won't go back to these graphs. So this is pretty much history for us. The peak is done, it's set in stone. What we do chase is daily updated CPI baskets in order to forecast where is inflation going, and then we can see a quite huge drop. This is the x-axis, the axle. So we're going to see where we're going to end up in terms of the CPI, but it's going to be definitely going lower next reading, and it will be good fun if you can actually see another beat on the downside. This means that the entire rate curve in the US has shifted sharply lower, and no surprise there. And obviously we're very happy with this because we were already long US Treasuries. But it's also quite telling in terms of the Fed fund futures view on the Fed fund policy rates. That we're going to end up with a cut. We knew that all the way back. This is back in January 2022. So even before we start hiking rates, we knew we were going to end up cutting rates. Now, when the CPI was at its strongest momentum, that was back in March. That's when the market priced in peak CPI, and that's when all the underlying indicators were maximum strength. We saw quite a long period of maintained high rates from Fed, albeit at a lower level. Right now we see we're going to go a little bit higher, but we're going to go a lot lower, a lot quicker than we saw back in March. And that's really the pivot that we priced in back in October. Now the market is already anticipating that within 12 and 24 months we're going to see 4.5 cuts. That's 1.25% cuts. This is quite extraordinary to see how boneheaded almost the fixed income market has been in terms of pricing cuts way back in March. They were really convinced that you're going to see massive cuts there in 12 to 24 months. That means that this hike cycle is going to come up and then going to plateau quite quickly compared to other ones in 7 days, for example. This also means the Fed has shifted the language, and they are now, through natural language programming, we can see a shift towards being more dovish, which is quite positive, or obviously speaking about lower yields as well. Now the pivot that I've been talking about, this is the pivot for your naked eye. This is how we shifted the probability of further aggressive hawkish hiking in the US to actually slow down the speed of hikes and then eventually flipping all over to cuts. The starting mark for that in the fixed income market was mid-October, which obviously was a good starting mark for the equity market as well. All pretty much anticipated by CPI data and CPI models and Fed models, etc., etc. But this is really the pivot for your naked eye. And as I usually say, if you, I know there are different definitions of a pivot, but if you claim it to be that they're actually going to start cutting rates, then yes, your pivot's going to be around next September, October. But then obviously you're going to have missed the equity trough with almost a year. So we're a bit aggressive in terms of people claiming that the pivot is really going to start to cut rates. Like, no, not really. There are a lot of articles on this on Bloomberg I think is worth reading in terms of pivot. But then again, everybody's free to their own opinion. That's our opinion. Now that also means that we have seen peak yields. This is a position we have on with long US treasuries. Now that's not the biggest conclusion we've drawn from this. The biggest conclusion is the fact that we know that a lot of CTAs that we can front run now because the old CTA strategies aren't that hocus pocus. They obviously benefited from the huge trend, and we were invested in a lot of CTAs. Now we are de-investing from a lot of CTAs because as soon as they see a shift, and they can't grasp the macro, it's too short term. Then we can be wrong. The yields might take off again. But if we're anywhere near right, we have to secure profits, and that's what we're doing. We have sold off a number of CTA funds, and we're going to keep selling them off. Just because the fact, if this trend is right in the yield, they're just going to see lower and lower yearly returns. So it's a quite an aggressive call on CTAs, but please also remember that that's not really super aggressive from us due to the fact that we can follow daily updated CTA strategies on Bloomberg or from other ETFs, actively managed ETFs even. So it's not really that rocket science to predict peaks and troughs of more cumbersome CTA strategies. And that's sort of the biggest conclusion from this, on top of being long US treasuries. The swap spreads are in agreement. The pivot, we don't have to talk about the pivot, but if the pivot is right, then we, for the naked eye, try to show where's the Fed fund rates compared to a neutral Fed fund rates, and we're going to make that cyclically adjusted, like a P number, and then we're going to allow it to have a negative risk premia, a negative term structure, and then we use Atlanta Fed's research. You end up in this predictor of the equity market, which is sort of really outrageous, but it's also a bit good fun, and this is really why people are stressing and reading the pivot. In terms of equities, the equity sentiment has clearly turned in favor of the equity market, of course, and the election had a very, very small effect on this. If we front run and sort of break down this black line in the sentiment in a more speedily updated calculation, we can front run it by Twitter data, showing again upside. So we think we're going to have positive equity sentiment. We also know that we're in a positive territory in terms of risk. If you look at rate spreads, CDS, FX, vol, fixed income, vol, etc., etc. We also know that we are in positive in fear and greed measurements. We also know that the vol curve in VIX is showing us a buy signal and then keep on buying signals basically. We also know that in terms of highs, lows, advanced declines, bullish bears, we're in a sharply positive territory, i.e. appreciating rising S&P 500, this is through an ETF level. We also know that in terms of a sell-off, we are way beyond the trough, and the trough is statistically quite significant of pinpointing good positions to enter the market. This is back in October. This means that our view of Q4 is maintained. We had that view since June when we put in and overweighted our equities even more and took off cash. Now this quarter is obviously very strong given the statistical performance since 1928, but it's also quite positive to see how strong it is. And our daily liquidity counterparty risk model is also showing upside in the equity market. And we're getting flows. And this is a flow, and I calculate a bit different just to see sort of the push and pulls. And we're still above one standard deviation. And this is key for getting that market movement going, that we're actually seeing flows again. And this is probably the second time this year the market in earnest is trying to find a trough. The first time was in June. Our trough since June holds. But this is the second time, which obviously is quite positive. And also, please remember, we are in our indicators showing clear degree of positive gamma. We're actually getting some traction now with positive gamma, which makes the option expiries that we had last Friday a bit less stressful. And on top of these indicators, you're going to have Tobin's Q. This is the fifth time we have an equity sell-off since the 1950s, not being front-run by Tobin's Q. That means that traditionally we should have already closed the gap on the upside, but we haven't. It would be quite interesting to see where we end up. But please do remember that the sell-off is not front-run by Tobin's Q. We might have a good snapback that we're seeing right now in Q4. Also do remember that in terms of total factor productivity versus normal productivity, and also you can think of this as a sort of very sensitive profit measurement for US companies. This sell-off is not motivated by the usual fall that we see in this kind of profitability indicator again since the 1950s. And you can look at it from a PE number, cyclically adjusted, and then taking into account where the yield is, and you're in a buying mode, and you have been for quite some time. And you can look at it from a Heuber, i.e. is the market more prone to buying or selling, and they're more prone to buying. So I'm just been sort of rambling through now a number of theorems and indicators, and what I think is good fun with all of these is that they all indicate the equities are well supported, equity will keep on rising. I.e. that means that our equity weight, we go already maximum overweight, but as the equity market keeps on appreciating, we are also breaking new grounds, and we haven't rebalanced that yet. We're sort of walking that knife's edge now, trying to see for how long can we walk that knife's edge. Hopefully it won't be split in two, and then hopefully being able to see where we're going to go next in terms of reallocating some assets, because we really want to get the most from this rising equity values, due to the fact that we're still down on the year and it's a tough year, but it's a very calculated risk. I don't think there's, well, at least we cannot find a substantial way of modeling downside risks on the equity market. You can take one single indicator and throw it up there, but we don't really see anything convincing out there in terms of theorems or something bigger in terms of that. In our view, again, we might be wrong. We're also keeping growth. This is a very clumsy way of looking at growth. We're looking at MSCI's categories of value versus growth. We don't invest in that, but we use it as sort of strategic work. So yes, the growth should beat value. It has not, but we keep on it because we're still below the benchmark barrier. This is built on positioning. But you can also argue then, well, if yields are moving lower, growth will benefit. Yes, but things aren't that simple. The relationship between yields and growth versus value is actually a bit more complex. I.e. you have to look at the curve, for example, 2/10, and you have to know if the curve is bull or bear, flattening or steepening. So you have 4 conditions. And if we calculate those 4 conditions and put those in a time series, you have that in blue. And you can see that, yeah, again, the rate curve is definitely showing the signs for growth. So we're keeping on to that. And also do remember that our overall strategic view is that we're in a 94, 95, i.e. equity market is selling off, the broad economy isn't doing anything, and then the broad economy is falling, and the equity market appreciates because we already priced that. We believe that we're going to have a similar event this time around, that the equity market is falling off, pricing a sub 40 ISM. ISM will probably not go that far, but as the ISM falls below 50, do remember the equity market is leading the ISM, not following ISM. I'll talk more of that next week. But it's quite important that just because ISM falls below 50, you should not buy into what we all know is going to be 90% of the media outlets there going on about the US slowing down, etc., etc. It's already been in the market, and it's actually, I would argue, already been in earnings revisions. This is the earnings revisions on a global basis, and we believe that trough will hold, as a matter of fact, and the global economy trough will also hold. Why we believe the earnings revisions trough will hold is that because if you look at corporates, they're not telling us anything differently from that trough. The trough is also sharply correlated to economic surprise indexes. And we can look at it from a Citibank's point of view, we can look at it from Bloomberg's point of view, we can look at it from Barclays, Westpac, Goldman. Regardless of how you look at data surprises, you have a positive momentum. That is equal to a trough in earnings revisions, whether you like it or not. Another way of looking at this is that earnings revisions and the equity market is a small proportion of the economy. You can actually look at the national accounting data, and sometimes national accounting data can actually lead S&P 500, i.e. the mamas and papas out there are more business cyclical sensitive to the economy than the larger corporates, i.e. there might be high insights into the future direction of the S&P 500, for example, or Dow or Russell or whatever, if you look at national accounting profitability data. And that's what I've done in this time series, and this is actually where it's going in dotted line. This is quite an interesting little V-shaped recovery there going on that could actually lead the equity market. And that comes back to that we still have a huge demand. Yes, we can hike rates. Yes, it will kill off inflation. It will not kill off the consumer, etc., etc. Soft landing. That's a beautiful game if this is actually working from the Fed. Hats off. Completely impossible to translate into European context. We have to look at the market from a different point of view, especially the Swedish one, where yes, manufacturing, great. Consumption, it was in a recession even before they started hiking rates. So it's a completely different ball game in that sense. But right now, it actually works on an equity allocation level to be long all these sectors, which is quite interesting, albeit for different reasons. Now, in terms of GDPs, yes, they're troughing on a global basis. Yes, looking at 4,000 time series in the US, you still see, yeah, you can argue a slowdown, I call it soft landing, but still the level, strong level on consumption. Yes, they can afford a hike. Can Europe afford a hike? No, they have already done that and sort of already created a massive drop in equity valuations for Sweden or Europe for that matter. But that's already mostly been done, I would argue. Now you can actually see second derivatives in European macro models turning around. The recession risk in US sub 25. If you look at the Fed's own model, yes, it's 26% there as well. I tried to make this graph a bit more astute in terms of forecasting recessions. I think I failed to make it more visible for the eye, but I will come back with a new version next week. But I'm basically trying to combine the credit spread model with more sophisticated business confidence models that are not following the equity market, but actually, in fact, leading the equity market. And there are those, but you have to make a lot more statistical adjustments of the underlying business confidence models. So less well known, basically. It's funny how I tried to make something more transparent, and I completely failed. It might not be fun, it might just be sad in that sense. But anyway, from onwards and upwards, in terms of GDP data then, how come that we are so stubborn on our soft landing? Well, US economy is right now chugging along at a 4% growth rate if we were to believe the Atlanta Fed GDP nowcasting model. Consensus is 0.5% in Q4. It's a huge gap between 4% and 0.5%. The truth is probably somewhere in the middle, i.e., the economists out there and their consensus forecast, they're really bogged down that the world is unified in its slowdown. And I would argue more for blockification. You can't treat the world as one. You have to look at both the regions are moving upwards and the regions that are moving downwards. And that's a huge difference, I would argue. Global trade growing along nicely. This is the underlying reason why we're more skeptical on the euro dollar. But that said, you already seen what we've done in terms of the FX. We're always updated on our social web pages, so please look for more data there, and this entire package will be there. And we'll be back in a week with a new update. And I thank you so much for your patience and your time today.